Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to show you that GameStop was the original pump and dump, or was always a pump and dump. I want to put the nail in the coffin to this narrative that I started sharing in my previous video, which is that GameStop's self-destruction, self-implosion really started much earlier than the 2018-19, eighth, ninth inning of the story, but really started in 2007. Now, I talked about in the financials how their decision making stops making sense because from 2004 to 2007, not only are they seeing top line growth, but they are seeing store same store growth. They're seeing more sales per store and growing increasingly, right? 44% growth from '04 to '05, 61% growth in sales per store from 2006, or from 2005 to 2006. But look at this. In 2007, the year over year growth slows. And financially, GameStop's decision making, to me, highlights that without a doubt, management sold out this company. Management gave up on this company. And why does this matter for GameStop investors today? It matters for two reasons, a fundamental reason and a technical reason. Fundamentally, if GameStop's leadership since 2007 has not been incentivized for GameStop's success, but has actually been intentionally just milking the corporation for as much compensation as they can before it inevitably goes under, then fundamentally that means GameStop has that much more of an opportunity to outperform, right? It means that the historical numbers of GameStop are that much less relevant to the current modern day GameStop. If the prior ownership from 2007 to 2020 wanted nothing to do with GameStop's success, was not incentivized for GameStop to succeed, then it means that all those historical numbers are not useless. We can still glean some things from them, but it means that fundamentally, to the extent that management was trying to bankrupt the company, that is that much more wiggle room that the company, if it's actually trying to succeed, has to actually outperform. Technically, so fundamentally, management that's trying can do better than management that's not trying. Management that's not trying, or even intentionally trying to damage the company, um, means that those numbers are are far from restrictive, right? And that GameStop's ability to transform itself fundamentally is that much more probable. Okay, technically speaking, the reason why this matters is if GameStop has been waving the white flag, pumped and dumped since 2007, then that means it's that many more years of short interest accumulating, right? And we know that the reporting on short interest is spotty. We know that the ability to hide short interest within ETFs and swaps, etc., is ridiculous. And we know that the regulation for short sellers is, you could say, minimal or even potentially complicit, right? So if GameStop has actually been shorted since 2007, 2008, then we're talking about 13 years worth of bag holders that are short sellers rather than just talking about a couple years, right? 2018, 2019 worth of short sellers. And if you have 13 years worth of shorts that were hoping to never have to close because they thought bankruptcy was inevitable, because that's what GameStop basically communicated through its financials and decision making, then it's that much more reason to be emboldened as a GameStop investor today to know that, okay, if these shorts have been piling up since 2007, how astronomical could that short interest really be? And how less likely is it, therefore, that shorts have actually closed at all? So let me recap the financials real quick, because right here in 2007, you see the year over year growth slowing. So anyone, if you were running this business, if I was running this business and you cared about the business, you would recognize, okay, we need to scale back. We need to maybe not scale back, but we need to slow down our acquisitions, right? We need to start optimizing our same store sales, because the growth story is not going to last forever. And actually, it inverts just 1 year later. But from '07 to '08, what does management do? Well, financially, they add another 1,000 stores right in the middle of a market crash. From '08 to '09, in the valley of the market crash, they add another 250 stores, another 220 stores the next year. All of this in the middle of a huge recession, and all of this without any same store growth. So, and then what they're communicating in 2010, as I talked about in this last video I made, is they're acting like they're still growing even though they're not. Like they officially are bona fide lying to investors at this point in 2010. But here's how we know it was a pump and dump all the way back to 2007. When do they report 2007 numbers? April of 2008. What happens 4 months after they report these numbers, right? When they show that year over year growth is slowing, 4 months later, they change leadership. And not just a leadership change, they bring in an outsider who had ties to J.C. Penney, not exactly a successful company, had ties to BCG, who was essentially there to milk the cow, to string along investors, to do all of the heavyweight lying. Okay, the OG founders of GameStop were here to pump it and to dump it. And then the long tail of GameStop bleeding out its equity and lying to investors, they hired out that job to an outsider, compensated him very well. Hey, we're all going to make $1 million a year. We got multiple company jets. Like, just do the dirty work. Let's bleed this thing out. And we know that we don't actually believe in this company. So the financials say that GameStop sold out in 2007, 2008. The management decisions say that they sold out 2007, 2008. And then the company history, right? What happens after they change leadership, right? They go on a spending spree. Acquisitions, 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 acquisitions of all sorts of random different businesses, none of them hardly even related to one another, right? They are spending money like crazy, continuing to give an image of a growth story to placate, I don't know that word actually, but to pacify retail investors, right? So management decisions show that they're giving up on the company. And look at the dump after the pump, okay? Because who are the OG founders of GameStop? Well, it's a longer story, but I'll get into it. But basically, these three guys, Daniel DeMatteo, Richard Fontaine, Leonard Riggio, they are the guys who owned GameStop shares, who took GameStop public. Where did they take GameStop public from? It was actually nested within Barnes and Noble until they spun off in 2004. What do they do right away? They acquire EB Games. So they are saying, hey, let's ride the wave. Video games are growing. Let's become the largest video games business, right? Let's scale this thing like crazy, ride the wave. And then as soon as growth is slowing, look what we're going to do. Okay, here's Leonard Riggio. The minute that his stock vests, right? He has 1.5 million shares vested. These are shares, not dollars, right? The same day that they vest in 2006, right? He sells them all for a 10x return. For a total, like, he sells almost his entire ownership of this company. Now he's going to continue being paid in shares month after month, year after year. So he's got more ownership coming. But it just tells you from the jump that these guys did not believe in this company, but actually were here to pump the stock and then sell the stock, which is exactly what happened when you look at their market cap, right? Spinoff and IPO happens in 2004. Pump the stock. Now it's triple where it was. Now it's quadruple where it was. Now it's 10, 6, 8, 10 times where it was when they began. And even when they began was an automatic 2x compared to how it was priced back when it was just nestled within Barnes & Noble. So the big dog, Riggio, selling out. DeMatteo, how about this? As soon as your shares vest, sell them out for a 3x return. DeMatteo again in 2007. As soon as your shares vest, sell them out for a 4x return. Fontaine, as soon as your shares vest, sell them out for a 4x return. Riggio again. Look at this. All of these acquisitions are just shares being vested, and he's getting rid of all of it, right, for a 15x return. Ridiculous. DeMatteo again. Sell them all out, 4x return. All of these are happening. Look at these dates right in this 06, 07, 08 window when they know that the growth story is fading and they are fading their own company, right? Again, all the shares sold out. What's that? A 5x return. DeMatteo again, all the shares sold out, 5x return. Riggio again. Look at these sales, right? Let me just go ahead and sell 1.5 million shares worth at 58 bucks a share. What a dump. 1.5 million times 58. Oh, let me just cash out on $88 million real quick of this company that I don't believe in. Oh, actually that wasn't enough. Let me sell another 500,000 shares at 58 bucks a share. Again, when did this happen? During 2007, when he knows that the growth is slowing, but these full year numbers haven't been reported yet, and the management change hasn't happened yet. Right? So they're dumping, continuing to dump more shares. There's DeMatteo, Fontaine, there's some more. DeMatteo, there's some more. DeMatteo, there's some more. Fontaine, there's some more. Again, before the 2009 or right after the 2009 or 2008 numbers are reported. So this whole window, the insiders are cashing out of the company, which to me bolsters the case that they took this IPO to pump it and dump it, knowing the growth story wouldn't last, but taking advantage of the opportunity to cash in big. Let me make that case from one more angle, because some people would say that it's implausible that a company would artificially bankrupt itself, right? How could it really be that they brought in this guy, Jay Paul, simply to lie and destroy the company from within, that they IPO this company simply to cash out, right? Because they still had shares in the company, right? Wouldn't they want the company to exist? Well, they're getting paid those shares. They're not buying those shares, first of all. And second of all, they're selling those shares. They're not holding them all. And they're getting paid on top of what they're getting paid in shares. They're getting paid in salary. Again, we're talking $1 million a year. So could they have transformed? Could they have improved the company? Yes, but they chose not to. They chose not to. Here are a couple more reasons why we know they chose not to. Okay, the founder, right? Mr. Riggio, the late great Riggio, son of a boxer. His first love is Barnes & Noble. Okay? When he was a college student, he founded a bookstore, right? And then through connections, probably from his dad being a famous boxer, right? He gets these random finance bros some money his way so that he can buy a bookstore that was a huge bookstore, and now he's expanding them like crazy, right? Barnes & Noble is what he cared about, not GameStop. But what did he find with Barnes & Noble? Look what he found. By the end of the 90s, one out of every 8 books in the US were purchased through his chain. And it was met with a lot of criticism, right? Thousands of independent sellers, mom and pop bookstores went out of business, right? And Riggio's saying, hey, that's not our fault. We're not trying to do that, right? But the independent owners, the mom and pops, were saying, yeah, I don't know about what Riggio's saying, because it seems to me like he's trying to put us out of business. And it became so much so that it was even covered in a random show, right? This guy, Tom Hanks, pretending to be a Barnes & Noble manager, says, we're going to seduce them with our square footage and our discounts and our deep armchairs and our cappuccino. They're going to hate us at the beginning, but we'll get them in the end. What did Riggio find? Riggio found that bookstores were traditionally a poorly run mom and pop business, and that with scale and capital and a little bit of cleaning up the bathrooms, right? A little bit of larger aisles and a coffee shop in the middle of it, that he can put all these guys out of business. So Barnes and Noble's breakthrough came from taking advantage of an inefficiency within a traditionally mom and pop run retailer. So he has the idea, right? I could probably do this with video games too, right? Video games, traditionally mom and pop run, poorly run, over cluttered, not enough space type businesses. I could just take the finance capital, right? The leverage that I have financially to put out of business legacy mom and pop video game type stores. So the original founder of GameStop didn't even really care about GameStop, right? He was only there for the money. Barnes & Noble was what he was passionate about, right? Right. And if you think, hey, there's no way that a company would artificially bankrupt itself, well, what if I told you that that's exactly how GameStop started, was artificial bankruptcy? Okay, how did this Leonard guy found GameStop? He he planted his own guys to bankrupt the company that he wanted, and then he bought that company in bankruptcy court. Okay, look at this crazy story. Okay, James and Gary, who own this video game retailer called Babbage's, right? They've been running it for 10 years. Okay, this right here is the heart and soul of GameStop. But what do they do? What do James and Gary do? Well, they merge with this company, software, etc., who happen to be Riggio's business. So Riggio comes in. He sees this company called Babbage's. He says, hey, let's merge together and be one super video game retailer, right? And if you're James and Gary, you're thinking, hey, that sounds good, but I don't know. Like, I like the way we're doing it. I want to run our own business. It seems to be going well, right? Maybe you can help us with some finance, but we want to keep doing business how we're doing it. And sure enough, look, they operate independently. So, hey, you keep doing what you're doing. We'll keep doing what we're doing. No harm, no foul. But look what they do to the leadership, right? So they found this holding company, and Riggio, okay, I forget which hand is which, but Riggio on his side has his guys who happen to be named Matteo and Fontaine, right? These are Riggio's guys running the software, etc. side of the business. What happens with these two guys, James and Gary, one of them keeps running Babbage's, the other one gets promoted to be chairman of the holding company, right? Promoted. chairman of the holding company. But guess who's chairman of the holding company's executive committee? Riggio, right? So, so James McCurry, hey, you can be the chairman of the combined company, right? What a promotion. So great, right? And Gary, you can keep running Babbage's, and our guys will keep running software, etc. But just so you know, James, you don't actually have any power because even though you're the chairman of this holding company, I'm the chairman of the executive committee of the holding company. Look what happens next, guys. This is crazy. So Gary's running Babbage's. The merger happens in 1994. Guess what happens in 1995? Gary resigns. Why in the world would he resign 1 year later? Well, to do something else. Why would he want to do something else? It could be that he's just bored, or it could be that he was pushed out. If he was just bored and this was all genuine, what would you expect? You would expect James, the other guy who founded this business, to step back into Babbage's. Say, hey, it's cute that you're chairman. You can still be chairman of Neostar, but we need someone to CEO Babbage's because for some reason, Gary left less than 1 year after we merged. But what happens? Who's actually in charge? Riggio. Does Riggio send the guy who knows about Babbage's to go run Babbage's? No. Riggio sends his own guy, Daniel DeMatteo, to take over the Babbage's side. Now, how is James going to take this? Because James is probably going to say, hey, that sounds suspicious, right? Why are you sending your guy to go run our business? I thought we were running these businesses separately and we were going to keep running our business. You were going to run your business and we're just going to benefit from each other's scale. Here's what Riggio says. Hey, don't worry, James. We're going to promote you too. So now you're not only the chairman of the holding company, you're the CEO of the holding company. Oh, really? This holding company didn't have a CEO. Yeah, we just created the position just for you, James. Just for you, we created this position. By the way, you're still below me, Riggio, so you still don't actually have any power. And these companies are still going to operate separately, right? Babbage's and software, etc. They're still going to be separate, but you can be CEO now. You can change your LinkedIn bio. So, hey, don't worry about anything. We're just going to send our guy to go run your business, right? What happens within a year, right? So in less than a year, their guy resigns suspiciously. Riggio sends his guy, Matteo. Within 1 year, they merge amid declining sales. Oh no, things aren't going well. We have to merge into one single organization. Wow, within 1 year, DeMatteo planted into Babbage's tanks this company's operations so bad that they have to merge and he resigns. Within 1 year, he resigns. So if this was any normal situation, sorry, I was covering that up. If this was any normal situation, you'd say, oh, surely DeMatteo is a horrible CEO, right? And there's no way he's going to get hired again, right? Within 1 year, this company is merging back into each other and he's resigning because he did such a bad job. Now they say, hey, James, you can go ahead and run the combined company now. Okay. You can go ahead and run it, right? This happens in May. What happens 4 months later? We don't have enough money to buy inventory for the holidays. We are going bankrupt. Now, this could all be a coincidental story, except that we know how it ends, okay? Because what happens in bankruptcy? Guess who buys it? Riggio. Riggio sends his guy to go artificially bankrupt this business, right? To wipe it of its cash. This guy says, oops, sorry, resigns. They throw James into the fire, say, good luck trying to fix the fire that we just set. And, oh, turns out you can't, and you're bankrupt. Oh no, who will ever want this horrible, struggling business? Oh, I don't know. The guy that's been in charge of it the whole time, Riggio. So Riggio merges with Babbage's, plants his own people inside of Babbage's to bankrupt Babbage's so that then he can buy Babbage's for pennies on the dollar in bankruptcy court and make it his own and not have to share it. So if you think it's implausible that GameStop would artificially bankrupt itself, then how do you explain the fact that GameStop literally started because it was artificially bankrupted, right? And what does Riggio do, right? He takes their name too. He said, you know what? I like Babbage's. we're we're gonna run with that, right? Fontaine becomes the chief executive. Um, and who else is in the mix? DeMatteo. DeMatteo in 1996, right? Less than a year after you resigned, is hired back as president and COO. So, was DeMatteo doing a bad job? Is it a coincidence that Babbage's went bankrupt? Or was he doing exactly what he was told to do and then rewarded by getting an executive leadership position in the new holding company that now they own outright? Right? So what happens? Barnes & Noble scoops it up. After Barnes & Noble goes public, it nestles within Barnes & Noble for a few years, right? And then in 2002, Barnes & Noble becomes public. And then in 2004, GameStop becomes public. They spin off GameStop. 2005, they buy EB Games, riding the wave of the video game industry growth, right? The GameCube, etc. They buy a bunch of stores, increase sales per store, not really through their execution, but through the general industry trend of video games. And then they sell all their shares, not all their shares, but they sell so many shares, which they didn't have to really put their own capital into in the first place, right? Pass the company off to lie to investors, tell the story that the growth is still happening, but actually it was always a pump and dump. Pump, sell, 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 dump, leadership change, milk, 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 milk. It was never a company with a soul. It was a company that was Riggio's side thing that was designed simply to take advantage of poorly run mom and pop video game stores to leverage capital, right? To expand quickly, to then IPO quickly, to then sell quickly. It was never any of these guys' primary interest, right? They are just Riggio's friends. And it was never Riggio's primary interest. His primary interest was obviously Barnes and Noble. I mean, even on his deathbed, or not quite his deathbed, but like towards the very end, um, what does he say? In 2021, right? 3 years before he passed away, he says, I don't miss being a business person. I've had enough of that, but I do miss the book selling part, helping to find books to recommend to customers. Genuinely, this guy loved books. Obviously, he was not prepared for the internet, you know, but he loved Barnes and Noble. He never loved GameStop, even though he was the chairman the whole time, right? All these years preceding, or whatever the other opposite of preceding is, the years that come after, He's still milking this company for what it's worth. But the growth story died as soon as they sold out. And what happened since then in 2007? Again, acquisition, acquisition, acquisition. Even though sales per store are growing or slowing, I should say, they add 1,500 more stores in the middle of a market recession to to show that top line is growing, to hope that people don't think too much about how sales per store is actually not growing at all and how the growth story is dead. Once that gets exposed in 2010, the next growth story is mobile. And the way that they sell that is then by buying businesses, right? Buying Biometronics in 2011. The growth story becomes we're going to host video games being sold. That didn't work. Right? We're going to develop video games. That didn't work. Then it's mobile, right? Then it's Simply Mac. Then it's AT&T stores, right? And all of these were designed to simply, again, pacify investors so that the ownership does not get forced out, right? They don't want a takeover. They don't want someone else coming in saying you're artificially suppressing this company. You're obviously bankrupting it from within. You obviously have no desire in the best interest of this company. They just want to do enough to avoid that so that they can continue milking the company for what it's worth until they put in the kill shot in 2018. And what happens in 2018? Basically, their business, the AT&T store business, is actually crushing. And it actually has the potential to more than make up for the fact that they have not invested in their video game stores for literally 10 years now. They sold out on the video game stores in 2007, and then they just kept doing new things, saying the growth's over here, the growth's over here, but it was never genuine, right? And when the AT&T stores were doing so well, margins of 82%, sales continuing to grow year over year, profits continuing to grow year over year, almost all of it from software, right? From their internet plans, DirecTV, and phone plans, right? High margin, solid growth business. What do they decide to do? They sell it. They sell it for $700 million, right? 1 year sales. They sell it for 1 year sales. They sell it for 1.2, not even 1.2x gross profit. So, just another way to show that all these acquisitions were designed to burn through cash, to pretend that the growth story was still alive, even though the growth story died in 2007, and management said as much when they hired an outsider to bleed out the company, and they sold out the vast, vast majority of their shares, which they didn't even buy with their own money in the first place, right? They used Barnes and Noble's money and then um Wall Street money. Okay, I know this might not be that interesting to you guys. If you learned something, leave a like. I didn't even say this, okay, but thank you to those who have joined the channel as fans and friends. Thank you to those who are part of the Halo Sub Club. You still got 129 spots left. We're on a march to 2525. Would love for you to be a part of it. If I've earned a subscription, I appreciate it. Leave a like, leave a comment. Let me know what you think. And again, why does this matter? First of all, it's just interesting to me as a fundamental analyst to look at the fundamental management story of GameStop and realize, holy smokes, GameStop started with an artificial bankruptcy. That is how they got possession of GameStop in the first place, was by planting their own person in the company they wanted and bankrupting it. So it was started by artificial bankruptcy. It was pumped and dumped, right? For 10 times as much as their cost basis, right? And then it was sold out to outside leadership. A guy they didn't know, right? All these years before, it's all me and my buddies, right? It's the guys that I trust. That's who I'm going to bring in. Once they sell out, they say, I don't want to do this dirty work. I don't want to lie to investors year over year forever. I'm just going to milk whatever money I can. They pass the keys to the company off to an outsider, consultant guy, high growth guy. And then again, they just spend their money intentionally trying to dampen the financials while giving the language as if growth is still imminent or even presently reality, even though it wasn't. And then again, they bring in the kill shot when they sell off their AT&T stores. The the one acquisition they made that accidentally actually worked really well. This Spring Mobile business was actually crushing, and they said, we got to get rid of this because it might actually save the company, you know? So after they do that, they sell through inventory, right, to empty out their stores, make it look like they're going bankrupt. They buy back their stock, they increase their dividends, right? They put in the final icing on the cake to, oops, it didn't work out. When in reality, it's very, very, very clear they never wanted it to work out. So, what do you guys think? Fundamentally, do you think GameStop today has a dramatically better opportunity to perform as it relates to its financials in light of how obviously disincentivized legacy ownership was? Do you find it interesting that legacy ownership didn't even really care about GameStop, but it was actually just his sideshow? Do you find it interesting that they pumped and dumped? Do you think it's likely that short sellers have been shorting since 2007, 2008, and only increasing their short position every year since, as leadership made decisions year after year, again and again, offering language that did not match up with financials to clue the people who are looking at financials to say, hey, go ahead and keep shorting it, while pacifying retail investors with some fancy verbiage to make them think that it's all okay, don't even worry about it, right? They're just slowly, year after year, shifting the bag from legacy institutional money that wanted to be a part of this pump that needed maybe 10 years to be a part of the dump, right? We're just going to keep passing on these shares to retailers who think that it's deep value, even though there's no value here because we've gutted the company from the inside out. Fascinating that Ryan Cohen said, I'm tired of this story. And also fascinating that in Ryan Cohen's statements for years, he, especially the first several years of GameStop, he wouldn't even talk about what he's doing with GameStop. All he would talk about is how crooked and messed up Wall Street is. And he talked about it several times. I'll share that in a future video. But amazing to think about the technical support and the fundamental support that is in GameStop's sales, right? Not to mention just the karma, right? I mean, what a story to be involved in. What a stand to take against Wall Street, but also what a genuinely financially opportunistic moment to be a part of a company that's been bet against for 15 years now plus and gutted for 15 years, now actually resurrect itself with ownership that's aligned with shareholders. An amazing story to be a part of. Okay, that's all I got for you today. I will see you in the next one.